Welcome back to the Deep Dive, where we cut through the noise and get straight to the essential insights. Today, we're doing some serious financial detective work. We've got a stack of incredibly detailed sources here, all about how public companies, lay bare their financial health, and more specifically, what that number you always hear about, earnings per share, truly means.
Indeed. Our mission for this deep dive is really to lift the veil on the seemingly complex world of public company financial reporting. We'll be focusing on the core SEC forms you'll inevitably encounter. Think of them as the official blueprints of a company's financial life. And then we're going to truly unpack earnings per share, or EPS. We'll explore what it is, precisely how it's calculated, and there are some surprising nuances there. And, most importantly, why it's such a foundational piece of information for anyone looking to understand a company's performance, whether you're investing, researching, or, just trying to understand the business news better.
Exactly. Think of this as your personal shortcut to truly understanding the financial pulse of publicly traded companies, straight from the reports themselves. We're talking about the filings that companies have to make public, the ones that give us a genuine peek behind the corporate curtain. And then, we'll break down EPS into bite-sized, understandable pieces, including some of those surprising caveats to calculations that, honestly, often trip people up. So, are you ready to become a better informed financial interpreter? Let's unpack this. All right, let's kick things off with the absolute bedrock of financial transparency for U.S. public companies. The Securities and Exchange Commission, the SEC, and its reporting requirements. Many of us have heard of the SEC, but what exactly is it, and why do they demand companies file all these forms? It seems like endless pages of financial data sometimes.
That's a great question to start with. The SEC's primary overarching role is investor protection. Simple as that. They were actually established way back after the Great Depression, specifically to restore public trust in the capital markets. So to do this, they mandate that over 50 different forms be filed by U.S. registered companies. And this isn't just about bureaucracy or, generating paperwork. It's about ensuring that you, the investor, or really any interested party, have access to comprehensive, reliable, and timely information to make truly informed decisions. I mean, imagine trying to evaluate a company without standardized, verified data. It would just be a chaotic guessing game, right? Pure speculation.
But total chaos.
And here's a crucial point. All these filings are made electronically through a system called EDGAR. That's EDGAR, the Electronic Data Gathering, Analysis, and Retrieval System. What's fantastic about EDGAR is that all these filings are available online to the public for free.
Oh, okay. EDGAR. So anyone can just look this stuff up.
Yeah, absolutely. Anyone, anywhere. It gives you a direct, unfiltered line to a company's financial story, cutting out the middleman. You get to see precisely what the company itself is reporting directly from the source. It's an incredible resource for transparency, really.
That's a powerful tool right there. Okay, let's unpack the first big one, the cornerstone of annual financial reporting, Form 10K. I kind of like to think of this as a company's detailed annual yearbook. What's its purpose and what kind of story does it tell?
Form 10K is indeed the definitive annual report. U.S. registered companies, often called issuers, are legally required to file it. Its fundamental purpose is to provide extensive, detailed information to current shareholders and, importantly, prospective investors. It covers the company's business operations in depth, what they do, how they make money. It explicitly details the relevant risk factors it faces. Everything from supply chain issues to regulatory changes, competitive pressures, that sort of thing. Crucially, it presents the company's full financial and operating results for the entire fiscal year, complete with audited financial statements. And uniquely, it even includes the perspective of its executive leadership, their take on the results and outlook. It's a truly comprehensive overview of the past year and a look ahead. It's their official historical record for the year.
Okay, comprehensive is the word. And these aren't just filed whenever the company feels like it. There are really strict deadlines, almost like a financial sprint.
Precisely. The SEC understands the need for timely information. The deadlines, they actually vary based on the company's size. And that size is measured by its public float. Now, public float isn't just the total number of shares. It's specifically the market value of common equity held by non-affiliates. Think of it as the shares that are truly liquid, available for everyday investors to buy and sell easily, not shares locked up by insiders or executives.
Okay, so size matters for deadlines. How does that break down?
Right. This tiered system acknowledges that larger companies usually have more resources to compile these reports quickly, but also their information is critical to a wider audience, so faster disclosure is needed. Specifically, large accelerated filers, these are the giants, Companies with a worldwide market value of $700 million or more, measured at the end of their second fiscal quarter, they have the tightest deadline, 60 days from their fiscal year end. These are your big household names. Accelerated filers, the middle tier. Market value between $75 million and $700 million, and annual revenue of $100 million or more. Their deadline is 75 days. All other registrants. This broad category includes smaller reporting companies, generally those with annual revenues under $100 million. They get a bit more breathing room, 90 days, which makes sense, right? Smaller companies might need more time.
Got it. 60, 75, 90 days. So if I'm sifting through a 10K, and let's be honest, they can be hundreds of pages long, where should I focus? What are the absolute must-read sections? Where do I find the real juicy details, the insights?
That's where knowing the structure is your superpower. It saves you a ton of time. There are several crucial items. First, and arguably most important for understanding the story behind the numbers, is Part 2, Item 7, Management's Discussion and Analysis of Financial Condition and Results of Operations, the MD&A.
MD&A. Okay.
This is where management gets to tell their story in their own words. It's their perspective on the business results. What's fascinating here is it's not just dry numbers, it's the narrative. They discuss their financial condition, liquidity basically, cash flow, and ability to pay debts and capital resources. They summarize results, highlighting trends, risks, uncertainties that shape the year. Crucially, it discusses material changes compared to the prior period, giving you context. And it even delves into critical accounting estimates and assumptions so you see the judgments management is making. This section is just invaluable for understanding the why behind the figures. It's often the first place analysts turn.
I can see why. Understanding their perspective on their own numbers is key. Now, you mentioned risks. Market risk sounds like something absolutely everyone should care about. What does the 10K reveal there?
Absolutely. That brings us to Part 2, Item 7A, Quantitative and Qualitative Disclosures about Market Risk, Concord. This item addresses the potential loss in value of a company's financial instruments, think derivatives, foreign currency holdings due to changes in things like interest rates, exchange rates, commodity prices, broader market stuff. Companies have to provide both quantitative, so numbers-based info, and qualitative, more descriptive info. For quantitative, they might use tables or sensitivity analyses showing potential losses under different scenarios, or maybe value-at-risk disclosures. It gives you a structured look at their exposure. On the qualitative side, they explain their main market risks, how they manage them, their hedging strategies, maybe, and any significant changes or future expectations. It's really about understanding their strategic approach to navigating financial volatility.
Okay, interesting. And then this is where we get to the actual audited numbers, right? The heart of the financial report.
Precisely. That's Part 2, Item 8. Financial statements and supplementary data. This is the core financial data, the bedrock of the 10K. And it's been meticulously audited by an independent accounting firm. It includes the 4 primary financial statements: income statement, profit loss, balance sheet, assets, liabilities, equity, snapshot, statement of cash flows, cash and out, and statement of stockholders' equity, changes in ownership. All prepared using U.S. Generally Accepted Accounting Principles, GAAP. That standardization is key for comparing companies.
Right, comparing apple to apples.
Exactly. And in terms of time periods, you'll see balance sheets for the 2 most recent fiscal years. Good for year-over-year comparison. For income statements, cash flows, and owner's equity, they actually provide data for the 3 most recent fiscal years. So you get a deeper trend analysis. Crucially, this section also includes the auditor's report. That's the independent opinion on whether the statements are presented fairly. Think of it as an external stamp of approval. And finally, you have CEO and CFO certifications. These are formal sign-offs from the top execs vouching for the accuracy of the 10K. Adds a layer of personal accountability.
Okay, so the 10K is the big annual review, the comprehensive picture. But companies don't just go dark for a year, do they? They have quarterly reports too.
Correct. That's Form 10Q. It's the quarterly report filed for the first 3 fiscal quarters of every year. Think of it as a regular check-in on the company's health between those deep annual dives. It gives you an updated overview of operations, interim financial statements, a snapshot for the quarter, plus other info like legal updates or recent stock sales. It keeps investors informed more frequently about ongoing performance.
And the deadlines are tighter for those, I imagine.
Yeah, a bit tighter. 40 days for large accelerated and accelerated filers, and 45 days for everyone else. The quicker turnaround reflects the fact that these interim reports are generally unaudited.
Unaudited. Okay. So are the financial statements in the 10Q as detailed as the 10Ks, or are they more condensed?
They are similar, but yeah, there are notable differences, mainly because they're unaudited and have shorter deadlines. They can be presented in a condensed format, streamlining things a bit, but they must reflect necessary adjustments to fairly state the interim results. If adjustments are just normal, recurring stuff, they state that. If not, they need to provide a detailed description so you understand any unusual items that hit the quarter. For balance sheets in a 10Q, you typically see the most recent quarter end compared to the preceding fiscal year end. Helps track changes since the last big report. Sometimes they include the prior year quarter too, which is super helpful for seasonal businesses. Income statements show the most recent quarter, the year-to-date period, and the corresponding prior year periods. Sometimes even cumulative 12-month periods, which smooths things out. Same idea for cash flow statements year-to-date and prior year-to-date, maybe cumulative 12-month too.
And the MD&A and market risk sections, are they in the 10Q too?
Yes, but again, they're focused. The MD&A in the 10Q, Part 1, Item 2, zeroes in on material changes since the last fiscal year end and significant shifts in the latest quarter and year-to-date results. It's an update, not the full annual story. Same for market risk, Part 1, Item 3. It discusses changes in market risk exposure since the last 10K. It's about what's new or different in the shorter term.
Okay, so 10K annual, 10Q quarterly. Makes sense. But what if something absolutely major happens right between those filings, like big news breaks?
That's exactly what Form 8K is for. This form is filed by U.S. registered companies whenever a material event occurs. It's not scheduled, it's event-driven. This is about immediate transparency for significant news that could really impact investors' decisions. Think of it as the SEC's breaking news alert for companies.
Material events, like what sort of things trigger an 8K?
Oh, a range of significant things like bankruptcy, obviously critical, acquiring or selling off major assets, big strategic shifts, changing their independent accounting firm, sometimes that's noteworthy, changes affecting their stock or debt, big changes in directors or top officers, leadership shifts, amending bylaws or articles of incorporation, changing their fiscal year, significant financial statement changes or restatements, that's huge, or signing material definitive agreements, major contracts, partnerships, etc. And the deadline is super tight. Generally just 4 business days to file this form once an event triggers the requirement. It's designed to get crucial info out fast.
4 business days.
Yeah.
Wow. Okay, so to recap this first part, we have the 10K, the big annual picture, the 10Q, the quarterly check-in, and the 8K for those urgent material updates. These are the key public windows into a company's financial life. So for us, the learners, what does this all mean? How does knowing this help?
It means the information is genuinely out there and easily accessible, which is incredibly empowering. Understanding these forms helps you move beyond just headlines and, company marketing spin. You get to the actual data, management's own words. It helps you assess financial health, spot potential risks or opportunities that might not be obvious. This is essential whether you're an investor, a business professional analyzing a competitor, or just someone curious about how companies really work. It's about building a solid, fact-based understanding.
Okay, that lays a fantastic foundation for where we find the numbers. Now, let's shift gears to a metric you hear about constantly. It's always in the headlines when companies report earnings, earnings per share or EPS. What exactly is it, and why is it so incredibly important? Why does it get so much attention?
EPS is absolutely fundamental. Under U.S. GAAP, all public entities, or those even just preparing for a public offering, are required to present EPS prominently, right on the face of their income statement. In essence, it tells you how much of a company's profit is allocated to each outstanding share of common stock. It's calculated by taking net income and dividing it by the common shares.
Profit per share. Simple enough, right?
Conceptually simple, yes. But the calculation can get tricky. It's a critical measure of profitability on a per-share basis. And that per-share part is key. It gives investors a standardized way to compare companies, apples to apples, regardless of their total size. A smaller, highly profitable company might have a great EPS. It simplifies the complex profitability picture down to a single, easily digestible number per share. That's why it's so widely quoted and analyzed. It shows the value generated for common shareholders. Now, how a company discloses EPS depends entirely on its capital structure. It's not one size fits all. You have simple capital structure. This applies if a company only has common stock outstanding, meaning no other securities that could become common stock like convertible bonds or stock options. These companies only present basic EPS. Then you have complex capital structure. This is where it gets more involved. If a company does have securities that could potentially be converted into common stock, securities that would dilute or reduce the EPS if they were converted, then these companies must present both basic and diluted EPS. Diluted EPS is like a what-if scenario, showing the impact if all those potential shares became real.
Okay, basic and diluted. That makes sense, showing the current picture and the potential future picture if more shares come into play. But what if a company sells off a part of its business, a discontinued operation? Does that affect how EPS is shown?
Yes, absolutely. Good question. If there's a discontinued operation, a segment disposed of or held for sale, the basic and, if applicable, diluted per share amounts for that specific item must also be presented. This can be done right on the income statement or clearly laid out in the notes to the financial statements. This ensures transparency. You can see the per share impact of the company's ongoing continuing operations separate from the parts being divested, gives a clearer picture.
Okay, so let's start with the basics, literally. How do we calculate basic EPS for a company with that simple capital structure? The foundation formula.
For a company with only common stock, the formula is indeed straightforward. Basic EPS, income available to common shareholders. Weighted average number of common shares outstanding.
Income available to common shareholders. Is that just net income?
Not quite. It's close, but there's a key adjustment. You start with income from continuing operations and net income, but then you must deduct any claims that preferred shareholders have on those earnings. This includes dividends declared on non-cumulative preferred stock. Even if they haven't paid them yet, if declared, they come out first. And for cumulative preferred stock, you deduct dividends accumulated in the period, whether they've been declared or not. Because with cumulative, those dividends pile up and must be paid before common shareholders get anything. The logic is critical. Preferred shareholders get paid first. What's left is what's truly available to common shareholders.
So what if the company has a rough year? A net loss? Do preferred dividends still factor in then?
Yes, that's a very important nuance. Even if there's a loss from continuing operations or a net loss, the amount of that loss attributed to common shareholders should actually be increased by the preferred shareholders' dividends or claims. The rationale is the same. Preferred gets their cut first, even if it means making the loss bigger for common shareholders. It accurately reflects the slice of the loss borne by common equity.
Wow, okay. So the numerator is income after preferred claims. What about the denominator? Weighted average. Number of common shares outstanding, or WACSO, Y weighted average.
Right, WACSO. This is crucial because a company's share count isn't static. Companies issue new shares, they buy back their own stock, treasury stock, they do stock splits. It changes. You can't just use the number of shares at year end. That wouldn't accurately reflect how many shares were actually entitled to earnings throughout the entire period. So the weighted average calculation reflects shares outstanding, weighted by the portion of the period they were actually outstanding. Shares sold or bought back are time-weighted.
Okay, time-weighted. So how do you calculate that? What goes into it?
So, the components you need to consider for WACS are shares outstanding at the beginning of the period, your starting point, plus any shares sold during the period weighted based on how long they were outstanding. If sold July 1st, they count for half the year, minus any shares reacquired, treasury stock, during the period, also time-weighted for the portion of the period they were not outstanding, plus stock dividends and stock splits, and this is key. They are treated as if they happened at the beginning of the earliest period shown, retroactively adjusted. Minus reverse stock splits, also retroactively adjusted.
This retroactively adjusted part for stock dividends and splits sounds important and maybe a little counterintuitive. Can you explain that more? Why retroactive?
It's a key principle for comparability, really fundamental. Stock dividends and splits are treated as occurring at the beginning of the earliest period presented. Why? Because they don't actually change the economic ownership of the company. They just divide the existing pie into more smaller slices, split, or fewer, larger slices, reverse split. Your percentage ownership doesn't change. So, to ensure EPS figures are comparable across different periods, if prior years are shown, their EPS calculations must be restated as if the split or dividend happened back then, too. This prevents misleading jumps or drops in EPS just because the number of shares changed mechanically. It keeps the trend meaningful.
Okay, makes sense for repairability.
And furthermore, if a stock dividend or split happens after the end of the reporting period but before the financial statements are actually issued or available to be issued, those adjusted shares are still included in the EPS calculation for all periods presented in that report. Same logic applies to reverse splits. It ensures the report reflects the most current capital structure, even when looking at past periods.
What about shares issued when one company buys another? A business combination.
Good point. If the acquisition method is used for a business combination, the shares issued in that deal are included in the weighted average calculation only from the date of the combination onwards, because that's when they actually became part of the acquiring company's structure.
Okay, this weighted average calculation seems critical. Let's make this real with an example. Our sources have one, and this is where, the details really matter.
Definitely. Numbers help solidify it. Here are the facts for a WACSO computation example. Imagine this timeline for a company. January 1. They start the year with 1 million shares outstanding. March 31. A 2-for-1 stock split occurs. Boom, shares double to 2 million. April 1. They sell an additional 3 million shares to the public. Total now 5 million. December 1. They buy back 500,000 shares as treasury stock, leaving 4,500,000 shares. We need to compute the WACSO for the entire year.
Okay, 1 million start, split to 2 million, add 3 million, buy back 500,000. How do we break this down step by step to find that weighted average, remembering that retroactive split?
Let's walk through it period by period, applying the rules. Period 1, January 1 to March 31, 3 months. Started with 1 million shares. But because of the March 31st 2-for-1 split, we treat these retroactively as if they were always 2 million shares from Jan 1 1M2 split factor. So for this period, 2 million effective shares, 312 months, equal 500,000 weighted average shares. The split affects the starting point. Period 2, April 1 to November 30, 8 months. After the split and the new share sale, they had 5,000 shares outstanding, 2M from split plus 3M new. This block was outstanding for 8 months. So 5 million shares, 812 months, 812 months, 833,333,000 weighted average shares. Repeating, of course. Period 3, December 1 to December 31, 1 month. They bought back 500,000 shares, leaving 4,500,000 outstanding for the final month. So 4,500,000 shares, 112 months, equal 375,000 weighted average shares. Total WACSO. Now just add up the weighted shares from each period. 500,000 plus 3,303,333 plus 375,000, 4,208,333 shares. That's our denominator for basic EPS.
That split adjustment really changes the beginning number. It's tricky because it happened mid-year but affects everything retroactively. Feels like rewriting history a bit for the math.
It does feel like that, but it's crucial for comparability. Another way to calculate it, focusing on the changes, sometimes helps it click. Start with the 1 million shares at Jan 1. The 2-for-1 split adds another 1,000,000 shares, effectively. Since it's retroactive, this adds 1 million weighted shares for the full year, 1M1212, so that's plus 1 million. Our effective start becomes 2 million for the whole year before other changes. Additional 3 million shares sold April 1, outstanding for 9 months, April to close, so plus 3,912 plus 2,250,000 weighted shares. Reacquired 500,000 shares to 1. These were out of circulation for 1 month. So 500,000, 141,667 weighted shares. Now sum it up. 1 million original start 12 and 12 plus 1 million split impact 12 plus 2,250,000 new shares 9 and 12, 41,667 reacquired 112, 4,208,333 shares. Both methods get the same answer, just different ways of visualizing the time weighting and retroactive effect.
Okay, that clarifies the WACSO denominator significantly. So that's basic EPS for simple structures. But what about complex capital structures again? Why the need for 2 numbers, basic and deleted?
Right. A company has a complex capital structure if it has securities that could potentially be converted into common stock. We often call these common stock equivalents. Think stock options, convertible bonds, convertible preferred stock. If these were converted, they'd increase the number of common shares. And if income stays the same but shares go up, your earnings per share goes down, right? It gets diluted. That's why GAAP requires companies with these potential diluters to show both basic EPS, ignoring them, and diluted EPS, showing the potential impact if they converted.
So diluted EPS is like a worst-case scenario number.
Exactly. The objective of diluted EPS is to measure performance while giving effect to all potentially dilutive common shares outstanding during the period. It's designed to show the lowest possible EPS, assuming everything that could dilute common shares actually does, provided it meets certain criteria we'll get into. It's conservative.
Got it. And what are the main types of these potentially dilutive securities again?
The main categories you'll encounter are convertible securities, bonds or preferred stock that can be exchanged for common stock, warrants and other options, like employee stock options, giving the right to buy stock at a set price, contracts settlable in cash or stock, where the company might issue shares instead of paying cash, and contingent shares, shares issued only if certain future conditions are met, like hitting earnings targets.
Okay. And the formula for diluted EPS looks a bit different. You mentioned adding back interest.
Yes, the conceptual formula is a bit more involved. Diluted EPS, income available to common shareholder, plus interest on dilutive securities net of tax. WACSO, assuming all dilutive securities are converted. That numerator adjustment, adding back interest, net of tax, applies specifically to things like convertible bonds. The logic is, if the bonds were hypothetically converted to stock, the company wouldn't pay interest on them anymore. So that interest saving after taxes would theoretically flow to the now larger pool of common shareholders. You adjust the income to match the assumed share structure in the denominator.
Makes sense, matching the income to the assumed share count.
Oh.
Okay, let's break down how specific types dilute. First, options and warrants. The source mentions the treasury stock method. What's that?
Right. The treasury stock method is specifically for options, warrants, and similar instruments. It's a hypothetical calculation. It assumes two things happen. One, the options warrants are exercised. Two, the company uses the cash proceeds received from that exercise to buy back its own shares, treasury stock, at the average market price during the period. The key is, if the options are in the money, exercise price is below market price, the cash proceeds won't be enough to buy back all the shares issued. So there's a net increase in shares outstanding, and that net increase is the dilutive amount added to the WACSO denominator for diluted EPS.
Okay, so you assume exercise, get cash, buy back shares, and the leftover shares are the dilution. Does this apply to employee stock options too?
Yes, it applies to equivalents like non-vested employee stock grants, stock purchase contracts, partially paid subscriptions too, and any options issued or canceled during the period or time-weighted for the portion that were outstanding.
Now, you mentioned in the money. Do options always dilute EPS if they exist?
No, and this is a huge point, anti-dilution. Options and similar instruments are only considered dilutive if the average market price of the stock during the period exceeds the exercise price. If the exercise price is higher than the average market price, they're out of the money, nobody would logically exercise them. Why pay more than market? In that case, the options are considered anti-dilutive. Including them in the calculation would actually increase EPS because the math works out weirdly, which violates the purpose of diluted EPS, showing the worst case. So anti-dilutive options are excluded from the diluted EPS calculation entirely for that period. And importantly, you don't go back and restate prior EPS just because market prices changed later. The test is based on the average price during the specific reporting period.
Okay, only include if dilutive, average market price, exercise price. So how does the treasury stock method calculation actually work step by step?
Here's the process. 1, check if dilutive. Is the average market price exercise price? If yes, proceed. If no, stop. They're anti-dilutive for this period. 2, assume exercise. Assume all dilutive options warrants are exercised at the beginning of the period, or issue date if later. Note the number of shares issued. 3, calculate proceeds. Figure out the cash the company would receive, number of options exercise price. 4, hypothetical repurchase. Assume that cash is used to buy back shares at the average market price during the period. Calculate shares repurchased, proceeds average market price. 5, net dilutive shares. The difference is the incremental shares added to the WACSO denominator for diluted EPS. Shares from exercised shares hypothetically repurchased.
Is there a formula for that last step?
Yes, the formula for the incremental shares is effectively additional shares, intersizes, number of shares, exercise price, average market price. Or you can think of it as shares issued, 1, exercise price, average market price. It gives the same result.
Okay, let's run the numbers on an example for this treasury stock method. The source gives us this scenario.
Right. Imagine a company has 1,000 options outstanding. Each option lets the holder buy 1 share. The exercise price is $15 per share. The average market price during the period was $20 per share. The period end price might be different, say $25, but we use the average for this calculation. We need the incremental shares to add to WACSO for diluted EPS.
Okay, $15 exercise, $20 average market. How do we apply the steps?
Let's break it down. 1, dilutive, yes. Average market price $20 is greater than exercise price $15, so they're dilutive. 2, assume exercise. 1,000 options exercised equals 1,000 shares issued. 3, calculate proceeds. 1,000 shares, $15 exercise price, $15,000 cash received, hypothetically. 4, hypothetical repurchase. Use the $15,000 proceeds to buy back shares at the $20 average market price. $15,000, $20 equals 750 shares repurchased. 5, net dilutive shares. 1,000 shares issued, 750 shares repurchased equals 250 incremental shares. So 250 shares are added to the WACSO denominator for calculating diluted EPS. That's the dilution effect from these options.
Okay, that makes the treasury stock method much clearer. Now, what about convertible securities, bonds, or preferred stock? How do they dilute? You mentioned the if-converted method.
Exactly. For convertible securities, we use the if-converted method. This method is different because conversion doesn't usually involve cash proceeds like options do. It simply assumes these securities were converted into common stock right at the beginning of the period, or issue date if later. This assumption affects both the numerator, income, and the denominator shares.
How does it affect them for, say, convertible bonds?
For convertible bonds, the if-converted steps are: 1. Adjust numerator. You add back to the numerator, income available to common, the interest expense related to those bonds that would not have been paid if they'd converted. Crucially, this is added back net of tax. Since interest expense reduces taxable income, not paying it means higher taxes, so you add back the interest saving minus the tax impact. 2. Adjust denominator. You add to the WACSO denominator the number of common shares that would have been issued if the bonds were converted according to their terms. And again, if bonds were issued mid-period, you time-weight the adjustments.
Let's try an example for convertible bonds. X company has 100,000 common shares and $500,000 of 6% bonds. Each $1,000 bond converts into 10 shares. Net income is $100,000. Tax rate is 34%. Compute diluted EPS.
Okay, let's solve for X company using if converted. Calculate diluted shares denominator. Start with basic WACSO, 100,000 shares. Conversion shares. $500,000 bonds, $1,000 per bond equals 500 bonds. Each converts to 10 shares, so 510 equals 5,000 shares. Total diluted WACSO, 100,000 plus 5,000 equals 105,000 shares. Calculate diluted net income. Numerator. Start with net income, $100,000. Add back interest saved, net of tax. Annual interest 6 for 500,000, $30,000. Add back interest saved, net of tax. After tax saving interest, one tax rate equals $30,000. 1.34 of $30,000, $19,800. Total diluted net income, $100 plus $19,800, $119,800. Calculate a potential diluted EPS, 119,800, 5,000 shares, $1.14.
Okay, $1.14, is that the final answer?
Yeah.
Or do we need that anti-dilution check again?
You got it. Always, always do the anti-dilution check. Never report a diluted EPS figure without comparing it to basic EPS first. Let's calculate basic EPS for X company. Income, $100,000. Basic WACSO, 100,000 shares, $1. Now compare. Our potential diluted EPS is $1. Basic EPS is $1. Since $1.14 is more than $1, including the convertible bonds would increase EPS. Therefore, these bonds are anti-dilutive in this scenario. So they are excluded from the diluted EPS calculation. The reported diluted EPS for X company would actually just be equal to its basic EPS, $1.
Wow. That's a huge aha moment right there.
Yeah.
So even though they could convert and potentially dilute someday, if the math for this period shows they'd actually make EPS look better, you ignore them for diluted EPS.
Precisely. Diluted EPS is only about showing the potential downside to per-share earnings. If a conversion hypothetically makes EPS higher, it's anti-dilutive and gets kicked out of the calculation for that period. It preserves the conservative nature of diluted EPS.
Okay, got it. How does if converted work for convertible preferred stock? Slightly different numerator adjustment you mentioned.
Yes, slightly different for the numerator, because preferred dividends aren't an expense like bond interest. 1. Adjust numerator. For basic EPS, we subtracted preferred dividends to get income available to common. For diluted EPS using if converted, we don't subtract those dividends. Why? Because if the preferred stock converted, those dividends wouldn't be paid anymore. So the full net income, or income from continuing operations, is used in the numerator, as it would now all be available to the expanded pool of common shareholders. 2. Adjust denominator. Add the common shares from the assumed conversion to the WACSO, just like with bonds, based on the conversion terms. And of course, the anti-dilution rules still apply. Only include if it reduces EPS compared to basic EPS.
Let's do an example for convertible preferred. Carling Company, 100,000 common shares, 10,000 shares of convertible preferred. Each preferred converts into 5 common shares. Net income is $100,000. Preferred dividends declared were $20,000. Common dividends were $30,000, though that's usually irrelevant for EPS calc.
Compute diluted EPS. All right, Carling Company solution time. Calculate diluted shares denominator. Basic WACSO, 100,000 shares. Conversion shares. 10,000 preferred shares, 5 common preferred, 50,000 shares. Total diluted WACSO, 100,000 plus 50,000 equals 150,000 shares. Calculate diluted net income numerator. Start with net income, $100,000. Crucially, we do not subtract the $20,000 preferred dividends here because we're assuming conversion happened, meaning those dividends weren't paid. So the diluted net income numerator remains $100,000. Calculate potential diluted EPS. $100,000, 150,000 shares equals $8.67, rounded.
Okay, $0.67.
Mhm.
Now for the critical check. Is this one dilutive?
Let's see. First, calculate basic EPS. Income available to common, it's just net income, $100. Preferred dividends, 20K, equals $80,000. Basic WRCSO for us, $80,000. 100,000 shares equals $4.80. Since the dollars and 67 is LSS than 80 cents, the convertible preferred stock is dilutive. Therefore, a calculated diluted EPS of $0.67 is correct and would be the reported figure. This one actually reduces EPS.
Perfect. That really clarifies the diluted versus anti-diluted distinction for convertibles.
And just to reiterate the general rules on anti-dilution, you test each potential common share issue separately. Use the results only if it results in dilution. Typically, you consider them in sequence from most to least dilutive, options often first, and the test should always be based on income from continuing operations. That's the baseline for the test.
What about those contracts that could be settled in either cash or stock?
If a contract gives that option, the presumption for EPS calculation is that it will be settled in common stock if that outcome is more dilutive. Again, always leaning towards the most conservative EPS figure.
And finally, those contingent shares, shares that might be issued later if certain things happen.
Right, contingent issuable shares. They don't require a cash payment but depend on future events, like hitting earnings targets or stock price goals. If they are potentially dilutive, they are included. If all conditions for issuance are met by the end of the period, those shares are included in basic EPS and also diluted EPS. From the date the conditions were met, they're basically treated as outstanding. If conditions are not met by period end, the number of contingently issuable shares included in diluted EPS is based on how many would be issuable if the current date, period end, was the contingency date. You use current earnings or market price to make that estimate. This includes potential future dilution in the what-if scenario.
So we've gone through the mechanics of calculating basic and diluted EPS.
That's a lot.
That's a lot. What else do companies need to actually tell us about these numbers in their reports? What are the required disclosures?
Good question. The calculations are complex, so transparency is key. Beyond just reporting the final basic and diluted EPS numbers for income from continuing operations, net income, and discontinued operations, companies must disclose several other things. A reconciliation of the numerators and denominators used for both basic and diluted EPS calculations, specifically for income from continuing operations. This lets you see exactly how they got from net income to the income figure used and from beginning shares to the WACSO used. Shows their work, basically. They need to show the effect given to preferred dividends in arriving at income available to common stockholders for the basic EPS calculation. Critically, they must disclose any securities that could potentially dilute basic EPS in the future, but were not included in the current period's diluted EPS calculation because they were anti-dilutive. This is super important. It flags potential future dilution that isn't hitting the numbers right now. And they need to describe any significant transactions that happened after the balance sheet date but before the financial statements were issued that would have materially affected the share counts, actual or potential. Gives you a heads up on recent changes.
That anti-dilutive disclosure seems really useful, knowing what could dilute later. Is there anything they specifically should not report related to per-share metrics?
Yes, one very specific prohibition. Cash flow per share should not be reported. JAP explicitly forbids this.
Really? Why not? People talk about cash flow all the time.
They do, and cash flow is vital, but reporting it on a per-share basis is seen as potentially misleading. Cash flow can sometimes be managed or manipulated for reporting purposes more easily than earnings. EPS is specifically an earnings metric. Investors looking for cash flow information should be directed to the full statement of cash flows, not a potentially confusing per-share number.
Okay, no cash flow per share. Got it. So we've covered filings, calculations, disclosures. What's the big picture? What's the ultimate passkey or cheat sheet for understanding when and how to apply these different EPS calculation methods?
Our source has a fantastic summary table, a passkey that boils it all down. This is really your go-to reference. Let's walk through it. For basic EPS, remember, only actual shares count here. Options warrants, no effect, ignored. Convertible bonds, no effect, ignored. Convertible preferred stock, no effect, ignored. Contingent shares, only included if conditions are fully satisfied by period end. Now for diluted EPS, assuming conversion exercise for dilutive securities. Options warrants, apply the treasury stock method. Assume exercise, use proceeds to buy back stock at average price. Add net incremental shares to denominator, only if dilutive. Average market price, exercise price. Convertible bonds, apply the if converted method. Add back after-tax interest expense to numerator. Add conversion shares to denominator, only if dilutive reduces EPS versus basic. Convertible preferred stock. Apply the if converted method. Add back preferred dividends, i.e. don't subtract them, to numerator. Add conversion shares to denominator, only if dilutive. Contingent shares. Include based on assuming conditions are met as of the reporting date using current status, only if dilutive.
That table truly is a shortcut to being well-informed. It lays it all out so clearly, what affects basic, what affects diluted, and which method to use. And always checking for dilution. It really demystifies it.
Exactly. It maps out the decision process, understanding these reporting requirements, the WACSO nuances, the different methods for potential diluters, and especially that critical anti-dilution test. It's fundamental. It empowers you, the learner, to critically evaluate financial reports, look beyond the headline EPS number, identify potential risks, or even just understand the components better. It helps you make more informed decisions, whatever your reason for looking at the financials.
And that, my friends, brings us to the end of another fascinating deep dive. We've peeled back the layers on SEC reporting the 10Ks, 10Qs, 8Ks, and really cracked the code on earnings per share. From the basic calculation to the brilliantly complex adjustments for dilution and, maybe surprisingly, anti-dilution. You now know not just what these numbers are, but how they're derived and why they matter so much.
My hope is that you now feel a greater sense of clarity and maybe confidence when you encounter these financial reports or hear EPS figures discussed. Remember, financial statements are really a language, and the more you understand their grammar and nuances, like EPS, the richer your insights will be. It's a powerful lens.
Absolutely. What stands out to you from today's deep dive? For me, maybe it was that anti-dilution rule, how something that could dilute is ignored if it actually makes EPS look better. Or just the detail in the WICSO calculation. Think about how knowing these details might change how you look at a company's financial news next time. Because being well-informed means asking better questions, seeing beyond the surface number.
And on that note, we definitely encourage you to take this knowledge and apply it. The EDGR database, as we said, is public and free. Try looking up a Form 10K or 10Q for a company you're interested in. Dive into the MD&A section, find the financial statements, look for those EPS disclosures and the reconciliation footnotes. See if you can spot how they calculated basic and diluted EPS. You might be surprised by what you uncover now that you know what to look for.
Exactly. It's all about the joy of discovery and the power that comes with understanding. Thank you for joining us on this deep dive. We'll be back soon with another stack of sources, ready to uncover more essential insights. Until then, keep learning, keep questioning, and keep digging deep.